What is cute and why does it involve mortgage-backed securities? Imagine a central bank trying to slow down an economy that's growing too fast and causing prices to rise. That's where quantitative tightening comes into play. It's a tool used by central banks to reduce the amount of money and liquidity in the financial system. Think of it as the opposite of quantitative easing, which is used to boost the economy by adding more money. During quantitative tightening, the central bank pulls back by selling off assets or letting them mature without reinvesting. This process makes borrowing more expensive and helps control inflation. Now, why are mortgage-backed securities involved? During times when the central bank wants to stimulate the economy, it often buys mortgage-backed securities along with government bonds. These securities are pools of home loans bundled together and sold as investments. When the central bank buys these, it puts more money into the financial system, lowering long-term interest rates and encouraging borrowing, especially for homes. But when the central bank switches gears and wants to tighten policy, it reduces its holdings of these mortgage-backed securities. It can do this by selling them or simply letting them mature without buying new ones. This removal of mortgage-backed securities from the central bank's balance sheet takes liquidity out of the system. It also causes mortgage rates to go up, making borrowing more costly for home buyers and businesses. This process is important because mortgage-backed securities make up a large part of what central banks hold after they buy assets during quantitative easing. When they reduce these holdings, it directly impacts the housing market and the broader economy. By shrinking the balance sheet, the central bank aims to slow down inflation, which can be driven by too much money chasing too few goods. In essence, quantitative tightening is a way for central banks to tighten monetary policy by shrinking their asset holdings, especially mortgage-backed securities. This helps to make borrowing more expensive, reduce excess liquidity, and keep inflation in check. Managing mortgage-backed securities is a key part of this process because they were heavily bought during times of economic stimulus, and reducing them reverses that boost to help slow the economy down.